We're kicking things off here. Today we have a private credit breakdown. We are deep diving into opportunity, opacity, and echoes from the subprime debacle. Ooh, are we back in 2008 all over again? Is it different this time? Does it echo of the past? Let me tell you why I personally love today's topic is because we are close to the private credit space. We are in the real estate segment, the niche of a private credit. It's a gigantic universe we'll dive into. But we get to beat up on some competitors here, and it's all in bounds. And we get to show you guys some good data, some good charts. As always, we'll check in with the Federal Reserve, see what they have to say about things. So today's going to be a good one. So, what's the overview for today? Let's jump in. Ange, also, if you have anything to drop now would be a good time for it. So, today we are going to cover the risks and the opportunities in the private credit universe. Why private credit has skyrocketed since 2008. Very important date for the history of private credit. What private credit is and what it is not. We're going to go through some deep definitions today, so we're very clear on it. And how to evaluate private credit investment opportunities and avoid hidden risks. Something that we do on every webinar. We like talking about the investment world. And we see a poll that popped up. We see some people joining us. Welcome for the newcomers here. Private credit. Do you believe the private credit market is currently in a bubble? Such a good question. I'm going to take a sip of water while you all fill that out. Ooh, we kept it simple with this question, so I like it. We're going to dive into what may or may not be in a bubble and what may or may not be not in a bubble. Yes, lots of yeses. Okay. Well, I'm very opinionated, so you'll definitely know where I stand by the end of this presentation here. All right, so what do we see? We saw 50% are yes, that we are in a private credit bubble today. We saw 30% said no and 20% unsure. Good. Well, I hope by the end that last 20% that we push you one direction or the other with everything that we're going to go through. That's the goal today. So, all right, let's dive in. Thank you guys for jumping in on that poll. We get to see where everyone's at. That's pretty cool for a large audience. But before we get too far, if we haven't had a chance to meet, I want to introduce myself. I am your presenter today. My name is Nick D'Angelo. I'm president here at Saint Investment Group. I am most proud of this slide, which represents an incredible amount of hard work by our team. Lots of achievement over many years being in the marketplace. We today have over 600 mortgage notes in over 29 states, and we are growing. Over 200 million in assets under management. We pay a fixed return all the way up to 12 to 14%. You get to choose the share class. And what I'm most proud of on this slide is that we have never missed a distribution to our investors ever. That has been for over a decade. We don't plan on breaking that streak anytime soon because I really like bragging about it, and we're really proud of our hard work for our investors. So we want to make sure get you guys paid every month. This is more of the same. This is an expansion of that. Over 14 million distributed to investors. We're again over 131 months of consecutive distributions to our investors. Very, very proud of that. Always on time, every time. I love that slogan. But I am biased, guys. I want to be upfront. I think Saint's the best company and the best investment opportunity in the world. That's why I put more money into Saint every single year. But what do other investors have to say? You're welcome to do a Google search, but I'll point you in a couple directions to kind of streamline that and get some third-party reviews. Trustpilot is going to be an amazing resource, and Google going to be amazing resources. You can see dozens of reviews, people that have worked with us, that have investor feedback of their experiences investing with us. So very good resources if you want to check those out on your time while you're Googling us or checking things out on our end. And before we get too far today, I want to make positive. Many of you already are, but if you're not, I want to make positive that you are on a first name basis with a very core member of the Saint team, Mr. Tom Furlong, who is our director of investor success. So guys, if you haven't talked to Tom, he's extremely seasoned, extremely knowledgeable, probably worked with, thousands of investors at this point, hundreds of millions invested, probably seen every type of portfolio concern question in the world. So I encourage you guys to get with him. But in the meantime, Tom, why don't you hop up, say hello, and tell the people what you can do for them?
Thanks, Nick. Yeah, I don't have the amount of investors handy. It's definitely in the thousands. We are at over 220 million at this point raised. That's between retail investors, so your everyday millionaire, your millionaire next door. It's also from industrial work as well, from institutions. And so we've worked with really everyone that you could see. So if you have a question that you say, "Oh, I'm curious if Saint is able to help out with that," I'm going to drop my contact here in the chat. So feel free to save my contact. We can schedule a call. What we can do specifically for the income fund is we can see your specific investment roadmap. If you have any questions on how we can help you in our investment strategy, we are so happy to do so. Nick, of course, is going to go through some fantastic information today. I'm biased. The best thing that we have is the income fund. And so I am honored to be able to talk to you guys and brag about what we do every single day in the income fund. So I empower you guys to schedule a call or shoot me a text here during the call.
Tom, appreciate it. And then everyone joining us, you'll see Tom's information in the chat. So you can call him, you can text him. Great guy, fun to talk to, very insightful. And then also you have Tom's calendar there. So if you want to book a protected time to connect with Tom this week, feel free to hit his calendar, book a time that works well for you as well. So, and then you can ping him throughout this presentation. We're going to be going through a lot, and Tom is standing by and available. So here's the layout for today. We will jump into a quick legal disclaimer, keep our attorneys happy. Then we're jumping into private credit. We're jumping into the topic. There's a lot there, so I want to make positive we have enough time to get through everything. We'll wrap up with just a little housekeeping at the end, and then we end with live Q&A, which consistently has some of the highest reviews on every webinar that we do. So I'm excited to jump in with you guys where you can ask me any question. We can have ongoing discussion, on great topics, whether it's investing in the fund, the topic today, the economy, etc. Live Q&A is where it's at. So quick word from our legal team, keeping the attorneys happy. I encourage you guys to read this slide, but I'll give you some quick highlights. Today is not investment advice. This is for educational purposes only. All investments are going to carry risk. Also, I'm going to talk about, I added this one. I'm going to talk about numbers throughout today. Some of these will be off the cuff, off the top of my head, through my own research and things that I do. I encourage you guys to verify these numbers. And then last but not least, Saint owns all the rights to this material. We spent a lot of time putting amazing stuff together for you guys, so we just don't want it to be reproduced or, sent out there in the universe. It's stuff that we want to hang on to. So with that said, last big announcement here. We are live on our book, Economics Over Politics. It's live right now on Amazon. Normally every month we do we go through a book that for our book club, for the Saint monthly book club. This month our book is Economics Over Politics. This book was made with one goal in mind, and that is stripping away all of the political angles and just sticking to the facts and the data in the US economy today. This has been the goal of these webinars as well. But what this book does is it allowed us, because it's a long form content piece, it allows us to take a massive deep dive into the biggest topics and the biggest economic trends in the US today. So it is detailed, but we do show our work. And also it's very approachable. We spend a lot of time making positive that even if we're doing a deep dive, it's something that breaks down these topics and strong points in ways that's easy to understand. So if you want to understand the biggest trends that we're seeing in the US economy today and for the next decade, that was the goal, was to really set the table for the next decade and how you can invest through them, then this is the right book for you to check out. Now, huge kudos to the team. We hit bestseller in 3 categories for this book. We hit bestseller in inflation. If you've joined me for webinars, you know I hammer inflation every month. Every webinar, we're talking about inflation. So we beat it. So we hit that in inflation, #1 bestseller. We hit US commerce, and we hit portfolio management, investment portfolio management, which really is what we cover on all these webinars. So this is the culmination of the biggest, most important economic points. So if you want to learn more, we put a QR code on the screen. You can scan that. You go directly to the Amazon. We're a bestseller in 3 categories, and your support has meant a ton. And if you haven't gotten the book yet, we would love your support. We're super proud of it. We know it will add a ton of value to you. So check the book out, guys. We really appreciate it, and we know it'll add a lot of value to you and your investing. With that said, let's jump into the world of private credit. What is it and how did it get here? Let's start with some real basics and some fundamentals here. The growth of private credit was largely a response to the post-global financial crisis reality of tighter capital and more regulatory constraints. Borrowers wanted speed, they wanted customized deals, and they wanted, most importantly, access to credit, which they were not able to get in the wake of 2008. The 2008 crisis served as a major point of change for tighter lending standards for banks really across the board for all of the products that they offered. And if we're being honest, that's probably fair because lending had probably moved a little too far in the direction of very loose. We saw around this time and leading up to this time, major movement to get every American a house. There was this movement that every American should be a homeowner. And the government and banks wanted to achieve this by loosening standards across the board. But with this pendulum swing, we see that swinging back, we see that the major increases in regulation have major impacts on the entire lending world post 2008. Even a prudent change, which I think we can all agree was prudent at the time, even a prudent change can cause unintended consequences. In this case, for what we're talking about today, since the global financial crisis, small and medium-sized businesses virtually lost their ability to borrow. These are for things like operations, for things like expansion, etc. Remember the days. Remember the days. Drop in the chat a thumbs up if you remember it. Remember the days when you were able to go in the bank with a business plan and they would give you a loan based on a business plan? That existed. Many people forget that aspect of American banking back in the day. But when was the last time that we really saw that? Those days are gone. And the GFC was really the major turning point where many borrowers, even very qualified borrowers, could no longer get loans for banks for many of their needs. Private credit business loans were a way for non-bank lenders to benefit for the need for lending, while the borrowers benefited from being able to access funds. And we saw investors got access to higher return opportunities. So that private market, that private credit market really benefited a lot of people across the board. So private credit in a nutshell, what is it? Private credit is, in a nutshell, an entire industry that has developed and evolved to serve the needs of borrowers outside the normal banking industry. Small and mid-sized businesses rely on the flexible terms and custom deals that match their needs specifically. Restrictions on private credit or a retreat fueled by fear have slowed down small and medium-sized companies' efforts to grow, especially since 2008. What we saw instead was only large companies had access to lines of credit. So it created a situation where we now have a system of credit haves and credit have-nots. But the small and medium-sized businesses were often still very qualified. I want to just hammer that point home. So private lenders in the meantime have stepped in and started lending to these groups to fill that need and that gap. So let's take a look at the growth of private credit, especially more recently. We're going to look at since 2020. Growth rates across private credit managers have consistently grown since 2020, with major players continuing to add assets under management and offering their investors more opportunities to invest in private credit offerings. However, some of these well-known funds have been involved in the recent events that rattled investors in private credit. And we will look at these details after we also look at the size and the growth of the sector as a whole. Overall, what we see is that many of the biggest players, and you're seeing this chart here, many of the biggest players have doubled their holdings in private credit in the last handful of years alone. This is clearly a huge need for there is clearly a huge need for these credit lines in the business world. The question is, and I think it's the question we're all asking. The question is this sustainable? And what happens if these loans go bad? Right? We don't want another 2008. So let's take a look at the demand for private credit, which fueled the rapid growth. Private credit began mostly lending in the United States market and then only later becoming a global asset class, like many things in finance, actually. The US remains the largest market today, but Europe and other regions have also started to grow rapidly in the past decade. US assets under management in private credit is already past 1.3 trillion today, and it's expected to hit 2 trillion by 2030. Similarly, on the global stage, global growth has taken total AUMs to 2 trillion this year, with projections reaching as high as 5 trillion by 2030. With this huge growth came changes, bringing a much broader variety of flavors, if you will, each requiring custom evaluation and custom business plans to the private credit space. Diversification within private credit definitely evolved over time, is the note. It was not all there at the start. We didn't start with what we have today. Early after the GFC, private credit was dominated by plain, vanilla, corporate direct lending and mezzanine lending. It was only after the 2010s and 2020s did it really expand into today's larger menu of asset-based finance, real estate debt, infrastructure, specialty finance, et cetera, et cetera. With how complex a lot of investing has become, the loan structures have evolved with these evolutions to now offer credit to the different niches. CAIA, the Chartered Alternative Investment Analyst Association, points to the evolution from corporate term loans to the financing of specific asset cash flows over the last 10 plus years. Asset-based financing today includes consumer finance. These are things like installment loans, auto loans, credit card receivables, point of sale finance. Then we have our hard assets. My personal favorite, Saint's personal favorite, right? These include aircraft leases, equipment leases, transportation assets, but most importantly, this includes residential and commercial mortgage pools. We're very partial to hard assets, so we invest into this sector quite a bit. Next, we have commercial finance, trade receivables, small business factoring, inventory finance. We have contractual cash flows, royalties, whole business securitizations, data centers, telecom. These are things that have contractual revenue streams. Each of these categories is niche. They've become more niche over time and has its own considerations and valuation models. Now, what does Saint stick to? I kind of already said it earlier, but I'll simplify it further. We stick to real estate debt. Why? We just went through a whole bunch of options here. So why do we stick to real estate debt? Because the collateral and the valuations. It's not more complicated than that. We know that what the asset is worth. We know that the asset is something real and physical, and we can take that collateral back if that loan isn't paid. So we do play in this world, this large world of private credit, but we play in what is typically considered the safest and honestly the most boring part of the private credit universe. So I want to make that point as we go through here, is there's a lot of segments of private credit, and make sure I'm clear with where we play at Saint. Okay, let's talk Blue Owl Capital, which many people that voted yes, that there is a bubble in private credit, probably have seen the headlines of Blue Owl Capital. So let's dive in here. Okay, so we have a booming industry. We have a market that has a lot of opportunities. We've seen that by the charts and the graphs. But let's take a look at a case study of a big name we may have all seen in the news, and it's not for good reasons. Let's take a look at Blue Owl Capital here. They probably have received more attention than any private lender in the last several years. What Blue Owl is a diversified fund group across several sectors. They cover software, technology, healthcare, insurance, financial services, consumer debt, asset-based finance, and technology lending. Okay, that last one got them in a little bit of trouble, among others. The funds are primarily comprised of floating rate loans. Floating rate loans. I want you guys to stick that in your head as we go through here, because it'll frame the rest of the discussion. They also prioritize first lien senior secured loans. Very good. That's one of their most common asset classes. This gives Blue Owl priority on repayment if the borrower defaults. They also hold subordinated and mezzanine level debts. So they really truly are kind of diversified across the capital stack in many ways. Blue Owl often holds small equity stakes in companies they lend to also, which allows them to profit from the upside if borrowers go public or get acquired. These stakes are the focus of recent concern about Blue Owl liquidity and the cause of the investor redemption requests that resulted in the recent redemption caps from Blue Owl. So here's the question. Is Blue Owl fundamentally sound? Truth is, yes, they actually are. It is a huge force still. Blue Owl is still a huge force in private credit markets today and hold an 87% market share of the GP stakes niche of private credit. Also, about 225 billion of its AUM is permanent capital, which provides a predictable stream of management fees. Those fees grew at 14% year over year, reaching almost 400 million in secured income. However, this is where it starts to get a little darker. Spread widening and maturing low-cost debt have squeezed their margins. The direct lending segment of Blue Owl has a net loss of 1% in Q1. And as mentioned, the stock price has suffered, currently at 52-week lows. This month, the board reduced the dividend for OBDC, one of their funds, which is actually their main credit vehicle, which along with the redemption caps have severely damaged investor confidence into Blue Owl. So let's take a glance. Let's do a breakdown here. The origin story of Blue Owl is worth mentioning. It's unique because this firm did not scale up from decades of a single investment offering. It didn't start small and get bigger over time and slowly grow into its shoes here. It wasn't built from the ground up. Instead, what we saw with Blue Owl is it was created all at once through a massive three-way blockbuster merger designed to capture the booming private equity and alternative assets market at one time. This was a merger of Owl Rock Capital, Dial Capital Partners, and then in late 2020, they took on, or excuse me, and then in 2021, they formed Blue Owl and acquired Oak Street Real Estate Capital for $950 million. So with those three mergers, they basically within a year were a massive player in private credit. Now let's talk share price. This is a big deal for these guys. Republic, right? As you can see from the fund info above, Blue Owl growth was rapid and success resulted in a healthy share price at first, which peaked at over $24 in January 2025. The early worries about Blue Owl stemmed from the base rate shifts. Again, I said this on a couple slides ago because they have floating rate debt. In private credit, base rate shifts are changes in the underlying reference interest rate. We're getting into some inside baseball, but track with me. This is important. The reference interest rate is usually SOFR. Okay. So many of you have probably heard SOFR. It's a calculation model that they use to benchmark and use the reference interest rate. These are how floating rates are priced. Most private credit loans are structured as floating rate coupons. The calculation of that is base rate on one side, so SOFR, right? Plus the spread that they add in on the other side. So the base rate is the short-term benchmark, SOFR again. This is reset periodically, typically quarterly, very commonly quarterly. And then the spread is the fixed margin that over the base rate. So you might have 450 basis points on top of SOFR. What this does is it compensates for borrower credit risk and illiquidity. A base rate shift is therefore a move in that benchmark. For example, SOFR rising 100 to 400 basis points with the Fed hikes, right? What this does is it feeds through almost immediately into borrowers' interest rate costs and the lender's income. Base rate shifts matter in private credit because private credit experiences faster pass-through of Federal Reserve policy. Since these loans are typically floating rate, bad, right? Changes in the policy rate via SOFR hit borrowers' payments quickly, unlike fixed rate bonds or mortgages that only reprice at issuance or at a refinancing period. Higher rates also mean higher yield for investors. That's good, right? That sounds good at face value. When base rates rise and all else is equal, nominal yields on those loans rise also. This benefits the lenders and it benefits investors that are holding these loans. But here's the problem. It also puts more strain on borrowers. The same base rate shift raises debt service burdens for leveraged portfolio companies, many of which Blue Owl has lent to. What this does is end up often weakening coverage ratios and increase default risks if earnings don't keep pace in these companies. Okay, That was a lot, and that was a lot of inside baseball. So what are we saying here? What we're saying is that floating rate debt causes risks for borrowers and also for the lenders. We most of us understand that it causes a lot of risk for borrowers because you don't know where that rate's going to go. If it goes up, things get more expensive. But it also causes risks for the lenders. This is a story we've seen play out over and over again in the investment world. This is also why Saint sticks to fixed rate debt because we have a much better ability to see and expect our returns and our payments over time. And our borrowers are not shocked when rates adjust in the market because their rate and their payment are fixed. So it's a long-term stability outlook going with fixed rates over floating rates. So let's dig in a little bit on Blue Owl. The context that gets lost in this cautionary tale about Blue Owl is how the problem started. Blue Owl has three primary investment funds. The fund that first had problems, which is OBDC2, is a $1.6 billion retail-focused private debt fund, which was not designed as a perpetual semi-liquid fund. It was actually intended to go public, providing market-based liquidity instead of liquidity windows. However, similar funds were being publicly valued at a discount, making the IPO unattractive and the changing structure of redemption options. Blue Owl then scrapped the quarterly redemption windows and then switched to a return of capital model tied to asset sales and other transactions. Okay, so what the heck actually happened here? What we saw is that this behemoth of a company wanted to go public with this fund, and they were banking on a specific share price to boost their returns. And when the market wouldn't support that share price, they had a very real oh crap moment and they had to pivot to staying private. Let's use this as a case study. This exact scenario is why Saint is private. That's why we will stay private and have no plans of ever going public, because this massive company was hoping and betting that a good share price would boost their returns. And when this wasn't an option, they had to change their entire model to stay private. Okay, so this is a good point. This is a good point here. At the end of the day, back to Blue Owl. As a result of their inability to go public and that they changed their model, and partly due to investor concerns over this, rightfully so, Blue Owl faced a sharp jump in redemption request and used its contractual gates to cap withdrawals at 5%. The OCIC fund received requests over 21% of shares, while the smaller tech-focused OTIC funds received redemption requests at 40% of their shares. Blue Owl attributed the run on the market concerns about AI disruptions to software companies. That was that tech thing I noted earlier, right? Again, to note here that if AI or any new tech fad is a core of your business, especially at the fund level, you are going to see a lot of volatility. We will stick to real estate at Saint, which has been one of the most stable asset classes for 100 years. We'll let other people do the heavy, crazy, volatile bets on AI. The core concern about the funds. Overall, the fund level health of private credit today looks solid but uneven. And that's an important note. What we see is real stress in certain segments and structures rather than a broad imminent crisis in the whole space. Long run, private credit returns have been attractive, and performance through 2025 has generally held up across the private credit space, especially for diversified direct lending funds and for most stable asset classes. Overall, what we see is that regulators still describe financial risk from private credit as moderate to low today. So regulators are not seeing this as widespread throughout the private credit market, and more so as a risk specific to volatile asset classes that exist within private credit. The key message here is that private credit is not likely to be the next subprime lending disaster, but that private credit as a whole does contain pockets of vulnerability. You have to choose wisely what asset classes you invest into. The risks in private credit funds vary according to collateral strength, borrower quality, covenant strength, and fund structure. But those first two I would note as most important. Collateral strength and borrower quality are something you see consistently on every list for private credit. Core vulnerabilities of private credit funds flagged by the IMF include weaker borrowers, floating rates, and interconnected leverage. That's a new one, interconnected leverage. So when you see complicated structures like AI companies where there are multiple companies all constantly reinvesting into each other in confusing ways that are completely unclear, that's interconnected leverage. So key point, while no collateral type is permanently 100% safe, there are different levels of risk that vary widely within private credit. It's important to note and distinguish between collateralized and uncollateralized debt, hard asset between hard asset versus enterprise value, and senior versus junior claims in the capital stack. If we use Saint as an example, the Saint Income Fund is invested in the US only. We are hyper focused on that one market. Biggest market in the world, not a bad one to be focused on, right? We invest in residential mortgages, which is considered the safest and most stable asset class in real estate today. Our average LTV target is 50 to 55%. That means the borrower has a ton of equity. And in many cases, the borrower has more equity than the debt on their property. So they have a huge incentive to keep paying rather than lose their equity and lose their property at the end of the day. Even a huge shakeup in housing prices, let's say a crazy drop, an unlikely drop of 10%, this would not swamp the equity of our assets. And in a worst case scenario, which we get asked about all the time, where we have to foreclose, let's say, this often actually increases returns. Okay? This increases returns because of how much equity is in the properties that we use as collateral. Now, again, this is not our model, but it really does help us sleep well at night knowing that our worst case scenario often increases returns and is better than many people's best case scenario. If you're dealing with riskier debt, like when the collateral consists of accounts receivable or business operations or, God forbid, goodwill, like how do you monetize goodwill? Like how do you calculate goodwill, right? When you are focusing on these things on your debt side, there's a lot of higher risks to the value of those assets. When the collateral is in something very volatile like the tech industry and tech businesses, you will see a lot of shakeups over time because there's heavy winners and losers in the tech space. This is why we stay away from these areas, why we stick to real estate, where we can be conservative. We know the value of the property with a high degree of certainty. So what are the regulators looking at? What are they most concerned about? Let's dig in a little bit. The primary regulatory concern is not that private credit exists, but it's that it illustrates a migration of credit away from banks to more opaque vehicles that are less clear asset values, especially for many of the assets that we see in the private credit world. Now, a personal note here, I don't even agree with this concern. I think that this is completely missing the point of the entire private credit industry. Private credit exists because banks were not offering credit to small and mid-sized players. Banks often focus on profitability, like most businesses. So if they spend 100 hours on underwriting loans per week, as a random number, they want those 100 hours to be spent on the largest and easiest and most profitable loans. So I don't believe private credit is stealing away from the banks. I think private credit is servicing a part of the market that banks weren't even servicing, right? This is why Saint exists, because banks don't want to work with mortgages that the borrowers have missed payments. They want to focus on originating more loans because it's more profitable to them. Okay. Remember, here's an interesting case study. If a bank has a 2% credit line with the Federal Reserve, so their cost of capital is 2%, and they lend it out at 4%, what's their return? It's not 2%. If the bank's borrowing at 2% and lending at 4%, their return is 100%. They are doubling their money, right? So banking is very profitable with many of their products. And that means they want to focus on the strengths of their industry, of banking. So in this case, Saint can buy their non-performing loans at a discount. The bank has a balance sheet that's cleaned up, and we get good returns for our investors and keep people in their homes. Again, I digress a little bit. The Boston Federal Reserve argues that the largest risk is based on weaker borrowers with less transparent collateral. So if the collateral is confusing and they're bad borrowers, that's what Boston Fed is talking about here. I 100% agree with this. So in the real estate world, we're always underwriting the strength of the borrower, and we're always making sure we have a clear understanding of property value, which is our collateral here. A new report from the Federal Reserve says that risks to the financial system from private credit appear to be limited and manageable. In March of this year, Chairman Jerome Powell said he did not see a risk of contagion in private credit markets that could spread to the wider financial system, and that the central bank will continue to watch the situation closely. So he does not see contagion. He does not see private credit expanding or having major issues that expand to other asset classes. So tips for investors looking at private credit investments. We always make sure to cover this on webinars. This is important. This is for you guys. Investors should evaluate private credit as a set of distinct strategies rather than as a generic yield bucket. The most important questions are manager discipline, collateral quality, refinancing exposure, and dependence on bakelines. Most of these have strong common sense elements as part of any investment evaluation. Perhaps the most important thing to remember is that private credit is not one asset class with one risk profile. It's a broad set of strategies whose resilience depends heavily on where the lender sits in the capital structure and what collateral stands behind the loan or loans. In practice, that means the best opportunities are often the ones with the strongest downside protection, typically senior secured loans with clear collateral packages, things with tighter covenants, things that have a meaningful equity buffer beneath the debt. That is why we love real estate investing. Excuse me, that's why we love real estate investing into the lending side of real estate. The key question is not simply whether to own private credit, but which kind. Loans backed by diversified receivables, equipment, mortgages, or strong company assets generally offer better recovery prospects than unsecured or highly engineered and complicated structures, although collateral quality and underwriting discipline still matter massively across the board in all sectors. Private credit can be attractive and offer great returns, but only when investors remember that it is not one thing. Its safety and its suitability depend on collateral, security, seniority, and underwriting quality, not on the brand name or the label or anything that's more of a fad. You got to stick to the fundamentals when looking at private credit. Now, we go through these different investment models, these different investment strategies, really to get to one point on these webinars. It's something that we quote regularly. It's something that we quote as, really the perfect goal for an investment portfolio. That's creating an all-weather portfolio with the dream of having a portfolio that weathers any storm in any scenario. What we see, all that said, private credit and the broader market, what we see is that fixed income right now is the number one strategy that investors are bolting on to their current investment portfolio. Many investors already have their growth side covered. Stocks, real estate, et cetera, different equity investments that focus on growth and upside over time. But the fixed income component is consistently what we see as the biggest opportunity, and the big groups like Tiger 21 are increasing their positions in this fixed income component. The second note I'll make here is physical assets. If you didn't see that from this analysis here of the private credit space, this quality of the collateral is more important than ever in the investment world today. So building resilience in your portfolio, I would tell you adding fixed income and rooting investments into physical assets. Now, let's say you are looking at something like an income fund. What should you be looking at? Well, it's a big world, right? But what I would tell you is two things. One is, how long is the outlook of the income fund, right? We just saw that there are some income funds that have highs and lows. They're fixed rate, or they're floating rate debt. Those things can come and go with how their performance goes. We're focusing on 10, 20, 30-year investment structures and mortgages. So I would highly encourage you to be thinking long-term, looking long-term. How does the stability over a decade plus look for the income fund that you're looking at? And the number two is asset class, guys. It's more important than ever. We just saw, if you're betting on tech and you're betting on AI, the volatility will drive you nuts. It would make me sick to my stomach. But again, I like boring investments, right? I'm partial to that. So the number one thing we're seeing in the marketplace today are single family mortgages. Why? Because it benefits from rate fluctuations and from inflation, because there's a long-term outlook and it's a physical collateral aspect to it. It's very important. So we get this question often, so we ended up just wanting to include it in some slides. The first question we get is, what happens to investing in single-family mortgages if rates go up? And that's kind of the world we live in today. If rates go up, well, you look at the Federal Reserve, rates are likely to go up for the next couple years. So what happens to mortgage investing in that case? One, the portfolio is more stable because there's less refinances. So the mortgages that we have in the portfolio are less likely to refinance out. That means cash flow is more stabilized over time. There's less turnover in the portfolio. And then on the flip side, what happens if rates go down? Fingers crossed. I know we've all been crossing our fingers. Even the president of the United States has been crossing his fingers at rates going down, but probably not with the Federal Reserve and their outlook. But what happens if they do? Well, the good news about having a very low LTV is that this is a great position for us to be in if rates go down because it stimulates buying, which increases property values, which increases the equity in the homes. So the collateral actually gets stronger if rates go down. So in the case where refinances are likely to increase, aka rates going down, our returns actually go up. And again, we have a 10-year outlook on how we're approaching the fund. So if we boost returns and we have more cash in our pockets, we're going back to the market and buying more mortgages along the way. So we're only increasing buying and bolstering the portfolio. But that said, if you want to learn more about what we're doing in the Saint Income Fund, the first place is to hit up Tom. It's to get with Tom and learn more about how this might fit into your portfolio. Your investment here is backed by over 600 single-family mortgages in 29 states. We have personalized investment strategy calls where you can talk with Tom and see how this might be a good fit for you. You can text him. Tom, do you mind dropping your info in the chat for me?
Sure thing.
Awesome. So you'll have Tom's info in the chat. You can text him, you can call him, you can book a call with him at your calendar availability. But all that to be said, this is a breakdown of our return structure. We have 3 share classes, C, D, and E. Each have different flexibility components, each have different return profiles. So something good to understand, and Tom is happy to break these down for you as well.